Hi guys and welcome back to the Mindful Investing channel. Today I want to revisit Alibaba with you. A lot has happened since we last valued Alibaba. Charlie Munger doubled his position and the stock price continued to decline. So once again, let's have a look at Alibaba to figure out what returns it might offer if we were to invest right now. As always, we'll value Alibaba using a simple discounted cash flow model. To be able to value Alibaba using this simple DCF, we have to first make a couple of assumptions. So let's begin by assuming Alibaba's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Personally, I like to base my future growth rate assumptions for Alibaba on their historical growth rates. When we calculate Alibaba's free cash flow compound annual growth rate based on the last 5 years, we come up with an annual growth rate in excess of 30%. Because I always want to be conservative and to factor in some of the current regulatory risks in China, and to simply show how ridiculous Alibaba's valuation currently is, I only assumed a free cash flow growth rate for the next 5 years of 12% and for the 5 years following those 5 years of 8%. Next, we have to assume Alibaba's price to free cash flow multiple at the end of our holding period. Like with our growth rate assumptions, I only assumed a really conservative, maybe even depressed multiple of 10. So basically a price to free cash flow multiple at the end of our 10-year holding period of 10. Next, we have to assume Alibaba's buyback yield over our holding period. Alibaba already announced a $15 billion share buyback program last year, and during the last year they bought back around $7.5 billion worth of their ADRs. So if we assume that Alibaba will buy back the remaining $7.5 billion of their share buyback program this year, this will leave us with a buyback yield of around 3%. I personally also think that Alibaba will continue buying back shares at such a depressed share price. Because we calculated Alibaba's free cash flows to the whole company, which is normally funded by equity and debt, we have to calculate a discount rate for the free cash flows, factoring in also the cost of debt. To do this, we simply enter into our simplified DCF the market cap, the interest-bearing debt, and the interest expense of Alibaba. So now we can calculate our annual rate of return, so basically our IRR over our holding period for Alibaba, by simply adjusting the cost of equity until the number in the green box is equal to Alibaba's current enterprise value per share. When doing this, we come up with a cost of equity, so basically our expected annual rate of return of around 47% for the next 10 years, which is basically insane. So that's it for today's Alibaba valuation. Please feel free to ask any questions in the comments and leave a like if you enjoyed the video. Please always do your own research and never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.